Hey, it's Cliff, and this video is going to be for those who want to withdraw from their tax advantage retirement accounts like a 401k or a TSP to retire early without paying a hefty penalty to the IRS. For most people, tax advantage retirement accounts are used for slowly adding money with the hopes of being able to retire in old age. Usually a person will invest in their early 20s up until a retirement age that they are able to withdraw penalty free, which is 59 and a half. They do this hoping to make significant tax breaks. But what if a person doesn't want to wait until they're 59 and a half to retire? Well, this is when the IRS decides that they are going to take a cut of your hard-earned money at the rate of 10%. Then on top of that 10% penalty, you'll have to pay income tax on the money that is withdrawn as well. This comes to about 22% depending on your filing status and tax rate. This means the IRS will be taking close to a third of all the money that you withdraw early in the hopes to retire early and be financially independent. But there are loopholes for people who want to achieve FIRE, and I'm going to show you two ways of how to do it. The first one is a Roth conversion ladder. To do this, you will need to contribute to a pre-tax retirement account during your working years, like a traditional 401k or TSP. You'll take that traditional account's money and then roll over a year's worth of expenses to a Roth IRA. Now, you will need to pay income tax on that amount of money, so it's important that you plan ahead and try to lower your taxable income as much as possible. There's also a 5-year waiting period before you can withdraw that money from your Roth IRA, so you need to plan your retirement 5 years in advance. You can repeat this process every year and avoid the IRS penalty and hefty taxes. The second way to avoid the IRS penalty is through a 72T, substantial equal periodic payments, or SEP for short. When you decide to retire, you will transfer your pre-tax retirement accounts to a traditional IRA. From there, you will need to decide on 3 different methods of payment: the amortized method, the minimum distribution method, or the annuitization method. Now, the downside of this one is that once you start a SEP withdrawal, you must continue that annual withdrawal for 5 years or until you reach 59 and a half, whichever one comes first. But maybe all of this is a little bit too complicated, so I'm going to give you a bonus method on how you could structure your early retirement through a bridge account. To do this, you would contribute to a taxable account to bridge the gap between retirement. If you wanted to retire at, say, 55, you would set aside 5 years worth of living expenses to bridge the gap up until you could withdraw from your tax advantage retirement accounts at the age of 59 and a half. Now, of course, you would need to pay taxes on your taxable account, but for some people, the ease of mind of being able to access that money is well worth it. Now, of course, none of this is financial advice from me. I highly suggest you talk to an accountant who can set up a plan that works best for you. This video is meant to mostly be educational because this is a common question that I constantly hear is, why would I want to invest in all of these retirement accounts when I can't access this until I'm old? But if this video was helpful in any way, please leave me a comment down below. And as always, thank you for watching.